Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark explores the volatile equity markets. Zeal LLC CEO Adam Hamilton talks about the rise of gold and silver. Canadian Securities Exchange CEO Richard Carleton answers questions about the struggling junior markets. We'll talk to Ross Clark right after this.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Nice to be with you again, Jim, and we had another one of those volatile weeks.
But boy, gold bugs must be excited.
Yes, we had the biggest rally that we've had since the market topped back in 2011, 2012. And, we talked about this last week, and we offered a report to those who were interested. Clearly, we had so many tests of resistance levels coming down, in particular 2014, 2015, that it looked like a market that was ready to have a much, much larger move to the upside, very indicative of some of the big corrective rallies we saw back in the 80s and 90s. And clearly, the move through 1170, the early part of this week, was enough of a catalyst to get things going. The top end of the move being up around 1260. From our work, it would appear that we're not looking at the high here by any means. We have some very good models that we're working from 1976, 1983, 1993, 1999, all very, very similar structure to this, and we have some good upside resistance lines. Right now, 1350 would appear to be the first one that we would look at, and the more important one is up at 1460. I would expect that those lines will be tested within the near future, being the next month or two. And following that, we will look for a pretty substantial correction, probably back down under the 1200 level. So looking at seasonality, looking at the patterns, I think that's what we have in store.
Stock markets, again, a few days down, and then a nice bounce back up.
A lot of chattering. We finally had as we moved through this week, we had already had the Russell 2000, the small cap indices making new lows. The S&P closed at new lows. And as of Thursday, the Dow finally managed to close below its low close in January the 20th. Also happened to be below the August low close as well. Now, that has been a characteristic when we look at these eighth year of the presidential terms. And there's 6 of those examples when you look back, 1920, 40, 60, 88, 2000, and 2008. They all, as part of this basing phase, you get your first leg down in January, a bounce late January into February, then you put in a better low in February through early March. And what you want to see is a close that's below that previous support, which is exactly what we've got. And now if you can get an upside reversal, that should carry us back into March, April, and we would look for it to retrace a minimum of 38% of the break that we've had from the high, and 50% would be an outside possibility. But it looks as though we may be back past the worst of this, and it sort of part and parcel with what we've been seeing in the oil market and in the currencies. Oil never ever puts in V bottoms. It typically has a hard break like we saw here a few weeks ago. You then get the first retracement rally, 30 to 35%, which we had. That took us up to $34 a couple of weeks ago. Then you erode back down to test the low, and that's what we saw as of Thursday. So on Thursday, the oil market turned. Now you've got rumors from the United Arab Emirates about wanting to do something about production cutbacks. We had the same type of thing mentioned by the Russians a week or two earlier. So there's some, commentary there enough to put support into the oil market. And with oil stabilizing, that's putting the bid under the stock market as well.
It's interesting, though, how talk is cheap, though. Nobody has actually turned a tap down. They're just saying we might do it.
And they've all, over the years, managed to produce more than they were stating that they would produce. So it's always a question of, perception versus reality. But at this point, we've got a decent test of support. The oil stocks, the oil service group have been holding up well, and actually the pipelines have been doing the best of the group. Nice turn off the bottom, and most of those have managed now to surpass the mid-January highs. So there's the bias of those charts is starting to look much better.
Any more special charts for people, boss?
Well, we'll do an update for them on the gold here in a week or so, and I do have some work on the U.S. election cycle, the presidentials, that might be of interest. And if they want to put in a request, I'll be glad to send that one out.
Ross, thanks for chatting with us.
Nice to be with you, Jim.
If you have any questions directly for Ross, you can email him at ross.clark@cibc.ca. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Adam Hamilton on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Adam Hamilton, CEO of ZealLLC.com. Welcome to the show, Adam, and congratulations to your Denver Broncos.
Thanks so much, Jim. It's great to be here. We're so excited for that Super Bowl win. It was an awesome weekend. Lots of fun.
And now some of that excitement is transferring to the gold and silver market right now.
Yeah, it's pretty exciting. It's been just a miserable 2 years for everybody in commodities land, as you well know. Canada's really suffered tremendously from the oil plunge over the last 18 months. And the gold and silver investors, the true contrarians, we've just been beaten to within an inch of our lives. It's been absolutely horrible. But this year the metals are catching a bid, and the gold stocks are soaring. It's really awesome. And I think the catalyst, Jim, was that rate hike back in mid-December. As you know, the Federal Reserve hiked interest rates for the first time in 7 years, took the United States off that zero interest rate policy, and that kind of changed the whole dynamics of the stock markets. For most of those 7 years the Fed had ZIRP in place, the stock markets kind of levitated. They just rallied and rallied and rallied. And a key driver for that in recent years, since early 2013, was during the Fed's third quantitative easing campaign. Every time the stock market sold off even a little bit, some Fed official would come up to the microphone and say, hey, we're ready to step in if we need to. We will ease more if necessary to help the economy. And that's kind of code words for we'll help the stock markets if we have to. So as long as QE and later ZIRP was still in place, traders figured stocks would do nothing but rally. But once the Fed ended ZIRP in mid-December, that whole stock market levitation dynamic evaporated. And then people decided, hey, maybe we should diversify our portfolios. Maybe stocks don't rise forever. And I think that's the real reason that gold's caught a bid so far in 2016.
Gold usually is looked as a safe place to put your money, is it?
Oh, absolutely. Absolutely. It's been around for millennia. Most elite investment advisors all throughout history have recommended that every investor have at least 5% of their portfolio in gold. It's the ultimate portfolio insurance, Jim. If something bad happens in stocks or bonds or in your country or your currency, the part of your portfolio you have in gold, even though it's a small fraction, should rise enough to offset the losses in the bigger parts of your portfolio. So it's just incredibly imprudent not to have, 5 or 10% of every portfolio in gold bullion. And people have forgotten that. One ratio I like to look at is there's the dominant ETF in the world is the American GLD gold ETF, the Spider Gold shares. And you can look at the value of the bullion that ETF holds. Every day they publish a list of all their gold bars. You can figure out, how many dollars of gold bullion they hold. You take the value of GLD, the total gold bullion they hold and trust for their shareholders. You divide that by the market capitalization of the S&P 500, the 500 biggest and best stocks in America. And as 2015 ended, that ratio is at just over 0.1%. So you can kind of infer that American stock investors had about 1/10 of 1% of their capital invested in gold. and that's 1/50th, of what that 5% target is. Now, it's probably optimistic to expect American stock investors to go up to 5%. That's not necessary, but even between 2009 and 2012, they were up around 0.45, 0.5%. So, 4 or 5 times higher than we saw late last year. So the gold underinvestment was just massive after years of this Fed-conjured stock market levitation. And investors are realizing in 2016, hey, stocks go down too. We're overdue for a cyclical bear market, and I better have some gold in my portfolio to mitigate some of this risk. Gold is one of the few assets in the world that moves counter to stock markets regularly. So it's the ultimate portfolio hedge as well as portfolio insurance.
What's a better bet, gold or silver?
You use the word bet, Jim, so I presume you're implying speculation. Silver will definitely have bigger gains than gold. I look at silver as a leverage play on gold. If you look at silver and gold price action through the last 30 or 40 years, silver only moves big after gold is already moving, but silver amplifies and moves in gold. It's a smaller market. It's much more volatile. So if gold goes up 10%, maybe silver go up 20 or 30%, over some long enough period of time that investors can believe the gold rally is for real. So from a pure speculation standpoint, silver has a lot more upside potential than gold. Always has, always will. Silver is also more of an industrial metal. It's consumed. People put silver in their iPhones and all their gadgets, and those things just go into landfills eventually. Very little of them are recycled. So the silver supply is kind of used up, kind of consumed like oil in a much lesser sense. Meanwhile, all the gold that's ever mined is still there in gold coins. Gold, there's a little bit in electronics, but for the most part, it's never destroyed. And so the silver supply is much smaller. It's more volatile. Silver has much more upside. It takes less capital to move silver higher. So silver is definitely a better bet. But for portfolio insurance, I'd still choose gold. If you want to have that classic 5% to 10% of your portfolio in precious metals, you're looking for a hedge. You're looking for something that moves counter to stock markets that will preserve your wealth in times of turmoil like we're seeing this year in the stock markets. In that case, gold's a lot more stable and safe and secure bet. So silver is a speculation, gold is an investment, for me personally.
Although one person told me one of his strategies was to buy an ounce of silver every month.
That's great. I mean, that's really smart. It kind of reminds me of dollar cost averaging in the stock markets. You hear Wall Street talking about that all the time, how every month you should set aside a certain percent of your income and invest it, because sometimes stocks will be low, sometimes stocks will be high. And the same thing with silver. If you want to amass a silver position, it makes sense to just buy it gradually over time. Market timing is very difficult to do, as people like me know. I've been trying to do it for decades now, and sometimes I'm right, sometimes I'm wrong, but it's always a probabilities game. You never know when the bottom's going to be, when the top's going to be, when prices are really low or really high. So if you dollar cost average in, if you buy some silver every month, it's a great way to accumulate a position. And over time, since silver is going to rise due to inflation, due to more investment demand, you'll definitely make money in that. It's a really, really wise strategy, I think.
What's a better investment right now, gold miners or gold bullion?
Gold miners have radically more upside than gold. They leverage the gold price, usually in the order of 2 times to 3 times. Excuse me, I'm trying to recover from a cold here. I apologize. In early February, the main American gold stock index, the HUI, the HUI, that shot up like 21% in 3 trading days compared to 4% for gold. And that was really outsized leverage, like 5 times. But generally, 2 times to 3 times is the metric that you want to use historically. And so gold stocks have radically more upside potential than gold. And gold stocks have the added advantage right now of being just crazy undervalued, Jim. As you know, the sector has been just despised and loathed in recent years. And so it's been totally abandoned, left for dead. And so that HUI gold stock index in January, mid-January, sunk to a new 13.5-year secular low. Gold stocks had not been priced so low since July 2002, and back then gold was trading just over $300 an ounce. Yet, the latest full data available for gold mining costs is the third quarter of 2015's. And the elite stocks in GDX, which is the premier American gold stock ETF, essentially the same composition as the HUI, they had average all-in sustaining costs of $866 an ounce. So essentially they're making around $200 per ounce profit at the level they need to sustain their production indefinitely, even at those $1,050 gold lows back in mid-December right after the Fed decision. And so the gold miners are wildly profitable on a cash flow basis, even at $1,050 gold. But with gold challenging $1,200 again in February here, their profits are just exploding exponentially. So gold stocks have a lot more upside potential. But again, I really, really think it's important to have physical gold bullion as the core of your portfolio. After you get that 5% gold bullion position laid in place, then it's fine to have gold stocks, but they're more speculative investments than pure portfolio insurance type investments like gold. So it's kind of a different tool for different purposes in your portfolio.
What about silver miners? I know that sector really, really took a pounding with the low price of silver. A lot of companies either went out of business or merged with other companies. Are there some really good bargains there?
Oh, they're incredible. They're incredible. The silver space is a lot smaller than gold, at least for the dedicated silver miners. Silver, the economics of silver have never been as favorable as gold for mining. The mining operations, the cash flow is just so much lower for mining silver. The amount of ounces you can pull out of a deposit, there's only so many big deposits in the world that are pure silver deposits that are economical to mine, and not very many companies have access to these elite deposits. And so you're right, so many companies do go out of business, merge, but the survivors here, the remaining big silver miners or the pure silver miners, they're going to just print money in the next few years as silver recovers with gold. The upside potential in them is vast beyond belief.
We keep seeing these television programs about families or groups of individuals mining for gold in the Bering Sea, in Alaska, in the Yukon. How much of a factor are they in the gold market, or are they just something interesting to see?
I love those shows on Discovery Channel as well. Love Bering Sea Gold. I love Gold Rush. They're really entertaining, really interesting shows, but it's really called artisanal mining, Jim, and it's just absolutely trivial. I mean, I can't give you a percent, but I'd bet it's less than 1/10 of 1% of global gold production. It's absolutely, completely irrelevant worldwide. You hear about conflict gold occasionally. People, guerrillas in like third world countries running mining operations, and the amount of gold supply that contributes to the global gold mining is it's essentially zero. It's a rounding error. So it's not a factor in supply at all. And of course, with gold being hammered so much in the past couple of years, I think a lot of that artisanal mining has gone away. The allure of mining gold with your family and friends at 1900 was vastly greater than mining it at 1100. And so even if that ever was a material factor, which I really doubt, a lot of that's gone away just because the economics are much harder to make work now for small-scale operations.
You're listening to This Week in Money. I'm Jim Goddard. We're talking to Zeal LLC CEO Adam Hamilton. China has been buying every scrap of gold they can find over the last 5 years. Was that a good strategy on the part of that government?
I think it's absolutely brilliant. China has the biggest forex reserves in the world, obviously. I think the latest numbers were just published like the first weekend in February, right before the Chinese stock markets went in the week-long holiday for Lunar New Year. And I think they had something like $3.2 trillion worth of forex reserves, the biggest in the world. And they bought gold again in January. That's always a really interesting story to me, too. Back in July 2015, there was a record gold futures shorting attack on gold in the American futures market. At 9:30 p.m. on a Sunday evening, Jim, when no one was paying attention, a single trader dumped 24,000 gold futures contracts, each controlling 100 troy ounces of gold in less than a single minute. That pushed gold down $48 in that single minute and broke through critical support, like around 1150, and that led to much of late last year's gold woes. But anyway, the psychological cover, the sentimental cover for that gold futures shorting attack that Sunday evening was the Friday before that in July. The People's Bank of China had reported the first gold reserve increase in like 5 years or something, and it was like 57% increase. But that fell short of market expectations because people thought China would have a lot more gold than it reported. And back then, that weekend, people were saying, well, hey, China just bought X amount of gold. It's way short of expectations. They're done buying gold. And, a few people like me are arguing, hey, why would they be done buying gold? What if they're going to make more buys in the future? What if they just start disclosing their buys and they keep buying it? And every month since, People's Bank of China has increased its gold reserves. And there's still only 1 or 2% of those total massive forex reserves. So that prudent portfolio diversification applies to nation states as well as individuals. And, you look at the Western countries, they have, 50, 60, 70% of their forex reserves in gold. The European countries, the United States, and China is at 1 or 2%. If China wants to be a world power, as they're indicating by wanting their currency, the yuan, made into a reserve currency, which they just kind of got approval for by the IMF recently, they really need more gold exposure, a lot more gold, a lot higher percentage of their forex reserves in gold. So it's really prudent, and it's really smart that they bought over the past 5 years or whatever, and they're going to have to buy a lot more to get that to a reasonable level to have a reserve currency quality yuan.
How about China's attitude, though, towards the stock market? They urged every citizen to buy stocks, but now anybody who wants to sell with the Shanghai index going down is a traitor to the country.
Yeah, that's horrible. The stock market was a total disaster. Last summer we talked about the bubble there, and my subscribers and I actually shorted that. We bought put options on a leading Chinese stock ETFs, made out like bandits when that bubble collapsed. But it's so unfortunate for the Chinese people that their government encouraged them to buy hyper-speculative stocks trading north of 100 times earnings, and then to ban them from selling effectively on the back end is crazy. But the really wild thing, and I think that's one thing that's contributed to the global stock sell-off in January, was that China just has effectively unlimited power locally, effectively unlimited capital locally, through hundreds of billions of dollars to that stock market. And still, back in January, the Shanghai Composite broke below its lows it had seen, like, say, in August, initial lows after the bubble burst. It's not even China, which has got to be the most powerful central bank relative to its local economy in the world, could stop a stock market slide once it started. I think that was a critical factor in kind of getting the rest of the world's traders to say, hey, central banks are not omnipotent. They can't stop bear markets. They might be able to delay market cycles, but they can't eliminate them. But it's a real tragedy for the Chinese people, the way they've been manipulated into buying stocks and, not being able to sell when they wanted to. It's horrible.
Well, a big lesson for the Chinese government, too. And for the rest of the world, this is what happens when communists try to get involved in free enterprise. They don't really understand it.
They don't, but even capitalists, even capitalist central bankers, the markets are way smarter than any individual. You can't have a small group of people like the Federal Open Market Committee of the Federal Reserve make policy and decide where markets are going and have it work successfully. You need the free markets to have the invisible hand of millions of people making decisions in their best interest. And any command and control type directives, whether it's from a communist perspective or a capitalist perspective, are just doomed to failure. And it's really unfortunate. Back to that China situation, one thing that precipitated the earlier sell-off in the United States was the Chinese government, as one of their many measures to try to slow down the stock market slide, they decided to put in circuit breakers. And the first trading day of January 2016 was the first day they were implemented, but they were way too tight. I think that at 5% down, the market closed for 15 minutes, and at 7% down, it closed for the day. Well, in the United States, the close for the day level is 20% down, and 7% in the Chinese stock market is nothing. I mean, we saw 7% move so many days last summer when that bubble was bursting, and so that really freaked out the Chinese traders even more. You have all these retail investors, which is most of the Chinese stock market, and the markets were closed and they wanted to sell, and they're like, what the heck, how can we trust these markets if we can't even sell when we want to? Yeah, these command and control directives, no matter who they're from, always fail, and that erodes confidence in the markets, which leads to more selling. It's really ugly.
Speaking of command and control, what about U.S. Fed head Janet Yellen saying no interest rate hike right now?
Yeah, it was pretty interesting, her testimony this week. I watched it eagerly just because the Fed has had such a dominating impact on the stock markets in recent years because of its record easing, and that morning when Janet Yellen started testifying for the U.S. Congress Wednesday morning, the stock markets were up sharply. And then there was one part of the testimony, Jim, where she said that the negative interest rate policy, the thing the Bank of Japan just implemented towards the end of January, she said that she doesn't know if the Fed has the authority to do that. And right then the stock market started selling off hard because obviously U.S. traders want more easing, and the only options left here are more quantitative easing, a QE4 campaign, or NIRP, a negative interest rate policy, rather than ZIRP, the zero interest rate policy. And she was still fairly hawkish, I thought, as well. She said that, she still thinks the economy is going to recover and that the Fed can do gradual rate hikes. And I think the proof in the pudding was the fact that there was no giant stock rally after her comments. She wasn't as dovish as traders hoped her to be.
Is that really important for investors, or should you still be looking at fundamentals?
Oh, man, I wish you could look at fundamentals. One thing that's really destroyed contrarianism over the past few years is the fact that central bank distortions and manipulations of the markets have made fundamentals irrelevant. People like me who are hardcore fundamentalists, we've been saying, hey, stocks are overvalued. They're trading at 26 times earnings, 28 times as bubble territory. You got to get out. It's crazy. Have just been destroyed because central banks have just come in and promised to do more easing every time stocks sold off. So fundamental analysis hasn't worked at all in the last few years, which has been just a huge problem. But in the end, fundamentals always trump all these fake sentiment-induced moves, whether they're central banks sponsored or just a herd mentality sponsored. And so It's really unfortunate. I think fundamental analysis will come back into vogue in this new cyclical stock bear that's unfolding. But because central banks dominated the market moves in the past few years, people still look to central banks now before they buy or sell, the momentum traders. And so central bank talk, we call it job owning, is everything right now still, although that's going to fade as the bear market wears on.
Adam, can you tell us a bit about Zeal LLC?
Yeah, we're just contrarians. We've spent our whole life studying the stock markets and investing and speculating. We publish a couple newsletters for like-minded individuals, a weekly and a monthly. The costs are really reasonable, around $10 an issue with a subscription. We just want to help people who don't have, full time to study the markets like we do, understand the markets and thrive and trade better, and help them see through the central bank distortions and see how markets really work, understand the real cycles, and hopefully multiply their wealth in the process.
Adam, thanks a lot for chatting with us.
Thanks so much, Jim. Have a great day.
My guest has been Adam Hamilton, CEO of ZealLLC.com. Coming up, Canadian Securities Exchange CEO Richard Carleton on This Week in Money.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Richard Carleton, CEO of the Canadian Securities Exchange, the exchange for entrepreneurs. Their website, thecse.com. He's speaking to us from Toronto. Welcome to This Week in Money.
Thank you very much, Jim.
Now, Canada's junior capital markets have been in trouble for quite some time. People are looking for solutions to some of the problems. The Venture Exchange recently held a town hall type meeting in Vancouver to talk about the exchange. It was a pretty boisterous crowd, by the way, and told the regulators, hey, look, we need help here. Are the regulators listening? And are they really going to make any difference?
It's an interesting question because I think the regulators see themselves as being somewhat conflicted in that they've got twin mandates of promoting investor protection, but also creating the conditions for fair and efficient capital market operations. And I don't think anybody who's been involved in the development of the junior capital markets over the last few years would argue that the key objective for the regulators recently has been more on the investor protection side. And we see that in a whole range of measures that have been introduced, which, to be blunt, have significantly increased the cost of operation for a number of dealers, as well as increased considerably their civil liability exposure in just conducting their traditional business lines.
Are independent brokerage houses in big trouble? We just saw a Globe and Mail article that said that independent houses were on the way down. How important is the survival of independent brokerage houses to the CSE?
Well, they're very important. I think there's, again, no doubt that raising money for early stage enterprise in Canada is a very challenging exercise at the moment. And whenever you see an important channel of finance for these companies in trouble, as I think it's, again, abundantly clear that the independent brokerage firms in Canada are, then that's just going to simply make it more difficult for entrepreneurs of all stripes to raise the growth capital that they need to build their business. I think, if you want to talk about what the underlying reasons are, I would go back to my former comment that I think well-intentioned regulation from the, both from IROC and from the Canadian Securities Administrators, really has had a direct impact on the cost of operation. If you look at measures such as the customer relationship model, changes to the know your client rules, and the potential implementation of essentially civil liability for fiduciary responsibilities for the dealers, it has had a significant increase in the cost of operations for all brokers. The problem being that the smaller independent Canadian dealers just simply don't have the scale to be able to absorb these new costs, the same as their colleagues who work for bank-owned firms or international firms that have operations in Canada. So there's no doubt that when you combine the situation with the difficult market conditions, the lack of of mandates from the various traditional Canadian industries for corporate finance and mergers and acquisitions advice, the challenges that their investment advisors have in recommending client investments in early stage capital market stories, it presents a very bleak landscape for management and employees at Canada's independent brokerage firms.
What are the reasons behind the independent brokerage houses closing? Is it increased regulation, additional costs, things like that?
Well, I mean, I think I talked a little bit about all of those things in my previous comments. Again, all brokers are under these same pressures, but they fall particularly hard on the independent dealers who just don't have the scale to absorb the enhanced administrative costs. And when you, as I say, combine that with the constraints on their revenue side because of, again, very, very slow activity in terms of IPOs and capital raising in the natural resource space, and as well as the challenges they have in providing financing and earning commissions on, sale of shares to their clients, it does, as I say, paint a very challenging picture for those independent brokerage firms.
Can the junior stock exchanges in Canada survive without independent brokerage houses?
Well, I suspect that we will, because I think, as you're aware, there is a substantial non-dealer ecosystem for capital market formation. Typically, the exempt market dealers, or the EMDs, which are active across the country, have stepped up to fill at least part of the financing gap for early stage entrepreneurs. But certainly, as I mentioned at the outset, the dealers provide an extremely important gatekeeping and advisory role for clients and for entrepreneurs, and the system will be substantially less robust and effective if we do in fact lose a significant portion of the independent dealers in Canada.
Now, of course, we know where there's crisis, there's also opportunity. Do you think we might see new junior stock exchanges being created in Canada if the venture exchange stumbles and falls?
Well, we're in fact a new stock exchange that was formed. I don't necessarily want to say that it was as a result of our competitor stumbling or falling, but we certainly saw an opportunity back 11, 12, 13 years ago now to provide stock exchange services that used or relied more on things like the Internet to ensure that interested potential investors and companies had access to all of their the disclosure record and all of their regulatory filings and news releases, and of course the chat rooms and the bull boards and all of that sort of thing in order to make their investment decision. We specifically designed our rules to emphasize disclosure over having the exchange itself conduct a lengthy and detailed and expensive business merit review. That is the approach taken by some other exchanges active in Canada. And with that approach, we believe that we are able to deliver a much quicker turnaround in from the time that the company applies to list on our exchange and when they in fact do list. That higher degree of certainty, the companies tell us, makes it easier for them to raise money, because when they commit or when they raise money that's committed on a contingent basis, contingent with listing, they know that the listing in fact is relatively imminent, provided that they're, again, fully up to date in terms of their audited financials and disclosure record. So our objective is to deliver the lowest cost of public capital that is available for early stage company entrepreneurs here in Canada.
We're speaking with Canadian Securities Exchange CEO Richard Carleton. Is the mandate of the CSC in dealing with listed companies to ensure that all full and plain disclosure is provided and or to pass judgment on deals?
Well, any exchange in Canada requires that full, true, and plain disclosure has been provided to the marketplace in some way, shape, or form prior to the company listing. And that can be achieved through some form of prospectus, whether it's an offering prospectus or a non-offering prospectus. And increasingly, what you see are people using, of course, prospectus exempt means. The offering memorandum, which is almost nationally available at this point. I think Ontario's just joined the rest of Canada in the last couple of weeks, is one means for a company to provide full, true, and plain disclosure to the marketplace without going through a prospectus process. And there's also the obligation of every company upon listing to provide a listing statement if they haven't done a prospectus, which in fact stands as the full, true, and plain disclosure. It's intended to provide prospectus level disclosure to the marketplace prior to listing.
Would the CSE benefit from running a single platform with the ability to police shorting and front running?
Well, the shorting and front running question comes up a lot. The markets across Canada are regulated by the Investment Industry Regulatory Organization of Canada, or IROC, and they are responsible for administering all of the trading rules and policies, whether you are trading on the Canadian Securities Exchange, the TSX Venture Exchange, the Toronto Stock Exchange, Equities, or any of the other alternative trading systems that are in place. So it's not actually in our regulatory jurisdiction or our bailiwick to be able to implement different short sale rules or principles around manipulative or deceptive trading than are in place on the other platforms. That's the job of IROC across all of the trading platforms in Canada.
How much time and money is required to list a new or existing public company on the CSE?
Well, that depends. The goal, as I mentioned earlier, is to deliver the lowest cost of public capital in Canada. As I mentioned, the key advantage that we offer, over and above the fact that our fees, are very, very competitive, and they're also flat rate and predictable, so that we charge companies $500 a month once they're listed. We don't charge them additional fees to change their capital structure, to change their board, to change their management team, to issue press releases, or most importantly, we don't charge them fees to raise additional funds. Other exchanges operating in Canada charge listed companies for all of those things. So that when you add it up, the fees that the companies are paying to us are very competitive with their alternatives in Canada. But frankly, more importantly than that, I mentioned that given the nature of our listings rules and policies, it tends to be a shorter time period from the listing application to the actual date of listing. That tends to mean that your lawyers are charging you less because they're spending you less time on the file. Your accountants are charging you less because they are spending less time on the file. And other advisors, knowing that it will be a shorter time period, perhaps than they're used to, are prepared to allow for that in the fees that they charge. So, when you put together the entire package, as I say, it's a very, very compelling proposition for a potential public company to list on the Canadian Securities Exchange.
Now, some junior companies are upset with minimum board lots being sold below the previous trade in the last hour of trading in their stocks, trading under 10 cents, even under 5 cents. Could these trades, some of them for $25, $50, be a form of manipulation?
It's certainly possible. It is obviously something that's a real concern for companies. And, again, during the last century, worked at the Toronto Stock Exchange, and I can assure you there were concerns at that point that transactions that were printed near the close of the market, especially at the end of the quarter and the end of the year, may have been done for the purposes of manipulating may be a strong word, but shall we say influencing the overall market capitalization of the issuer involved. And that becomes a particular concern, as you point out, when you have companies with a relatively small market cap that trade in the 5 to 10 cent range. Clearly, it's something that the regulators do look at and watch out for. And there are, as I say, I can assure you, plenty of rules in the Universal Market Integrity Rules, which IIROC administers, to control manipulative and deceptive trading practices. And so the regulators are watching. But that said, it's always a concern when a relatively small amount of money can influence the overall market capitalization of the issuer.
Any chance the CSE will increase the board lot size for stocks trading under 10 cents?
Again, I don't want to be deferring all of these things to IIROC, but the board lot size is actually set out in the IIROC trading rules, the UMR that I referred to earlier. It is something that we're looking at and potentially prepared to advocate for with the folks at IIROC. The one concern on the other side of the ledger would be that would dramatically increase the number of odd lots that people are holding. So that the existing shareholders who have, for example, less than 10,000 shares of a particular issuer would wind up holding odd lots. Odd lots themselves can trade away from the national best bid, best offer, and so they receive no price protection or no. Again, they could theoretically trade at any price. So that could lead to a number of issues. So we'd have to look at that carefully. But increasing the board lot size would increase the financial risk associated with trying to influence the overall market capitalization of company with a board lot executed, near the close of trading for a day.
Shorting and the Uptick rule are under the jurisdiction of IIROC. There are approximately 13 trading platforms in Canada right now. Now, if each platform had to separately abide by a reinstated Uptick rule for all of its trading, no matter what the platform, do you think naked shorting would be a thing of the past?
Well, I'm been around the industry long enough to remember when there, was an Uptick rule, and it was in fact administered across the various trading platforms that we had in place. So it's certainly possible to implement it. I'm where I'm at on the issue is that I'm not confident that IIROC has properly or deeply enough considered the issues of short selling in the junior capital space. The studies that IIROC has looked at in implementing the abolition of the tick test for short sales, generally speaking, or in fact almost universally at this point, looks at large cap stocks, and I think it's it's beyond argument at this point that restricting short sales in the large capitalization stocks actually does restrict liquidity. It widens spreads. It decreases volume. So, as I say, when you're talking about a bank stock or a large energy company or so on, we would not be in favor of restricting short sales in the manner that is suggested. I think we really do need to take a hard look at what's going on in the junior capital market. I think the fact that you've got so much stress, particularly in the natural resources space, the stocks are trading, for less than 10 cents in many cases, and the companies themselves are desperately trying to keep their stock price above 5 cents in order to facilitate, capital raising. And I think that it is, in fact, possible for people to make substantial profits, trading profits, by shorting stocks in that price range, and doing so with relatively little risk. Now, as I say, I know that the view is held almost universally amongst the dealers and the companies in the junior capital space that this is in fact going on. If it is, it ought to be abundantly clear to IIROC, who see everything, right? They have very sophisticated programs which oversee trading activity. And with the audit trail that we have in place in Canada, they know the identity of every individual who submitted the order that shows up in the system. So any pattern of trading, any pattern of conduct, with respect to, say, stocks trading for less than 20 cents, would be immediately clear to anybody researching the point. The problem is, I have not seen any research that has in fact focused on that area of the market specifically. So we certainly advocate for research, and if the anecdotal evidence is true, we'd certainly be prepared to advocate for a reinstitution. Maybe not of the former tick test, but we've got some ideas around ways to put some roadblocks in the way of short selling that I think would be easier to administer and to implement.
It seems to be getting tougher to take part in a private placement due to all the regulations that deny people the opportunity unless they meet a lot of criteria. They can't be over 65 and so on. I've heard even billionaires have been turned down the opportunity to invest because of their age. If the accredited investor requirements and client relationships management were replaced with a standardized form, say just a page or two, would that help investment in the CSE?
This is, again, the great conflict that the regulators have presented us with, because on the one hand, there seems to be a very well-meaning, but perhaps ill-considered focus on investor protection and their activities. And, not only have we seen, we talked a little bit about the constraints that the dealers have been put under, and now these, prospectus exempt private placements, which are often done by exempt market dealers, also seem to be under significant pressure from the regulators by way of increased regulation, documentation, and other requirements. But then at the same time, we've got the regulators that are promoting crowdfunding in its various forms across the country as a means of encouraging people to invest in early-stage capital stories and startups and so on. And I find it personally impossible to reconcile the two directions. That on the one hand, we've got an extremely well-respected infrastructure of dealers and exempt market dealers in Canada who are, and I'm not exaggerating, renowned around the world for their ability to raise money for pre-revenue and early-stage business stories, who, are being subjected to ever more stringent regulation. And at the same time, we've got the regulators now articulating rules to provide for crowdfunding. As I mentioned, one of the problems is that we've got, I think, 5 different crowdfunding rules in Canada at this point. But, where there are relatively limited protections beyond limits on the amount that an individual could invest for people looking to put money into these businesses. So, again, I think that there needs to be a significant reconciliation of the policies around this that, in fact, provide for a single track where, registrants of various kinds, whether they're full-blown IIROC dealers or exempt market dealers, can in fact use the principles underlying the crowdfunding means of capital raising to basically reduce their costs and increase their client base and effectively sell securities over the internet. I don't see why we shouldn't be allowing those people to undertake those activities.
If Vancouver is still the junior mining capital of the world, could the CSE benefit by moving the head office to Vancouver?
I was afraid you were going to ask me that.
Yeah.
We've actually had an office in Vancouver since inception, basically, of the organization. And in fact, our head of listing sales is based in Vancouver. I work out of the Vancouver office regularly, and in fact, I look forward to it, especially at this time of the year when Bay Street can be a bit of a drafty, cold canyon. But and in fact, about 50% of the companies listed on the Canadian Securities Exchange are in fact domiciled in British Columbia. But that said, we also have important client base in Alberta, in Ontario, and in Quebec, and from the United States, and from Asia, and from Europe, and so on. So, I think it actually doesn't really matter where we're headquartered. For a bunch of reasons, our trading technology probably has to be in Toronto. But as I say, we cover the Vancouver market and British Columbia generally quite well, and I certainly enjoy every opportunity I get to come to British Columbia.
Just how proactive is the CSE in finding solutions to all these issues and problems?
Well, I mean, for us, it is the lifeblood. We have to ensure that prospective public companies can raise money, because if they can't, then there's frankly no reason for our existence. And a breakdown in the system for finding growth capital for entrepreneurs would, for us, really, there would be no reason for us to exist if that were to cease. And again, if you want to think about or look at what it looks like, just look at the United States. There is really no public early stage capital market anymore. People sort of still think of NASDAQ as that place, but it hasn't been that place for more than a generation. The public markets in the United States now, New York Stock Exchange and NASDAQ in particular, they are exits for private equity and venture capital and high net worth individuals who have invested in the Facebooks and the LinkedIns and the Instagrams and so on. It's a liquidity event. It's an opportunity for them to get their money out. It's not where companies go to raise money in order to finish the product, to hire employees, to lease space, to hire a sales team, or all of the things that companies need to do in their first year or two of existence. So the U.S. Has filled that gap, generally speaking, through private investment, and private investment that's really only open to institutions and to wealthy individuals. We think that's wrong. We think that there's a hugely important role for individual investors to profit in the growth of the Canadian economy and to help support the entrepreneurial spirit of individuals that increase employment and overall create wealth for the country. And we think Canada would be a much poorer place if we did not continue to support the continued vitality of our public markets.
Do you think more companies will be attracted to the CSE if it takes the lead in finding solutions facing the junior markets?
I think certainly if we're viewed as an opinion leader in the space, it can't hurt. But ultimately, it comes down to how much money can I raise and what is the cost. And if we happen to be, as we hope to be and intend to be, the place where people can do it at the most cost-effective rate, then they will continue to support our exchange.
What do you think people can do to help get the regulators and so on to make the changes that will make the Canadian junior markets more profitable?
They need to be participating in the conversation, and there is ample opportunity to do it. The securities commissions regularly put rules and policies and so out for public comment. It's available on all their websites, and you'll see news releases and so on. You don't have to go very far to find out. You should be part of the conversation. Similarly, IIROC, they have a public mandate. They periodically issue a number of rules and policies for public comment. They can and do respond to positions that are taken by, not just the exchanges and the broker-dealers and the law firms, but from individual investors. So, as I say, I can't encourage people strongly enough to become part of the conversation.
How can people find out more about the Canadian Securities Exchange?
Well, the most obvious place is our website at www.thecsc.com. And if they hold off for a few more weeks, they'll see a completely revamped, much more feature-rich site under that banner. But we obviously encourage your listeners and investors across Canada to come and have a look.
Richard, thank you very much for talking to This Week in Money.
My pleasure again. Thank you.
My guest has been Richard Carleton, CEO of the Canadian Securities Exchange, their website, thecse.com. And that wraps up our show for this week. We'd like to thank our guests Ross Clark, Adam Hamilton, and Richard Carleton, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.